Hello, Business Finance 330. This is Professor Hassey. It is Friday, April 8th, and this is our second video of our first week of class. This is what is called our Friday update video. And I hope all of you have begun to look at the Blackboard and begin to see what's involved in our course. I know I've answered a few questions. We had a couple students come to our Wednesday night student hours, and I see some of you are posting to the class discussion forum, but only about a half of the class has participated, probably waiting to submit and do your portfolio work as of today. But I still have 5 students who have yet to sign in to our Blackboard and sign into the course. I will be getting in touch with them later on today. Our agenda for today is just with the second videos to talk about any assignments or work that you're doing this week, and also look over some problems that kind of summarize the overall topics that I need you to get out of this first week of class, defined as what is finance. So first off, tonight you're working on your portfolio this week, doing a spreadsheet. So let's talk about that just a little bit, following up our conversation with my lecture video. Remember, I have supplied this template in an Excel version in Blackboard, and you are to select up to 1 to 5, for public traded corporations. Up to 5. You can pick 1, 2, 3, 4, 5, no more than 5. And your goal of this is to track these stocks and their performance and what they mean over the course of our 8-week Spring 2 session. The market is closed today, Friday, April 8th. Today's the date you get the prices of your portfolios of whatever companies you have selected. So you go into Yahoo Finance, Google Finance, as I described in my lecture video on Monday, find the price, determine the dollars allocated by you to that investment, and then you do a simple calculation dividing the price into the investment to get the amount of shares that you're purchasing on this April 8th. Round to the nearest whole number, and you got it. And then we'll be tracking these stocks and as their prices go up or down over the next 8 weeks. You also define the indexes, the Dow Jones Industrial Index, the S&P 500 Index, and the NASDAQ Index, which are indicators of overall market performance. The S&P 500 is defined in this week's Blackboard, week number 1. The Dow Index is defined in week 2. The NASDAQ Index is defined in week 3. You find those indexes, save it, and post your portfolio to the discussion forum, excuse me, in a thread that you create. And also in that thread, briefly explain why you picked the companies you picked. So that's for 10% of your course grade, and this posting is due midnight on Sunday, April 10th. In addition, this first week, besides getting used to Blackboard, making sure you understand the procedures, the working with Blackboard and the discussion forum, the understanding the weekly information providing you, watching our introduction video to the course, watching our course lecture video to the course, and getting up to speed. I also ask you not for a grade, but just if you can, review some problems at the end of chapters 1 and 2. Chapters 1 on pages 26 to 27 of your text, the 10th edition of Corporate Finance, and on pages 52 and 53 of chapter 2. And they kind of define the theme that I talked about in our lecture video on Monday, the definition of what is finance. And I want to take a look at the first question. Choose the term within the parentheses that best matches each of the following descriptions. Expenditure on research and development. That's an investment decision. You're investing in the future, R&D. Many of you might work for companies that have an R&D department. They invest in assets that hopefully will create new products and create new growth into the future. That's an investment decision. Remember, in finance, there's two types of decisions: financing decision and an investment decision. And this is one of the priorities with the chief financial officer. A bank loan, is that a real asset or a financial asset? That is a financial asset. It's a financial asset, especially for the bank, because it's providing capital as a loan to a company. So it's a financial asset. Listed on a stock exchange, closely held corporation or a public corporation? Well, the answer is a public corporation, because those are the public companies you're looking for in your portfolio for this week. It's listed on the New York Stock Exchange. Has limited liability, partnership, or a corporation? Well, we talked about this a little bit on Monday. Limited liability means you have limited exposure or risk if you screw up. What a definition that is. And that's limited liability is a corporation. The limited liability for a corporation is that you can only sue the assets of the company. You cannot sue the ownership of the company. That's limited liability. Whereas a partnership, you can sue the assets of a company, but also sue the partners as individual owners of the company. That's why corporations are a more attractive investment for stockholders, because there's limited risk by that limited liability inclusion. Many of you might have heard companies that are LLPs or LLCs, limited liability corporations, where companies are run like a small business, but they're treated as a corporation. Let's look at responsible for bank relationships, the treasurer or the controller. Well, it's the treasurer of a company. The controller is in charge of the accounting books. The treasurer is in charge of banking and cash management. Agency cost, the cost resulting from conflicts of interest between managers and shareholders, the amount charged by a company agents such as auditors and lawyers. It's the cost of resulting from conflicts of interest between managers and shareholders. Many times in companies, and you read about it in the newspaper, hear it on the news all the time, shareholders are unhappy with management. Sometimes they sue them, or sometimes they fight them with specific requirements put by the shareholders on the managers, and that comes at a cost, and it's called agency cost. Let's look at question 6, the definition of a corporation. The business is owned by a small group of investors, private or public corporation. That is an example of a private corporation, a very small group of investors. A private corporation cannot sell their stock in the general stock market. They can only sell it to the investors of the company. Where public corporations can do what you're doing with your portfolio this week, sell to the general public through the stock exchanges. The business does not pay income tax, private corporation or partnership. The business does not pay income tax. That's a partnership. The individual partners have to pay the tax on their individual returns, but the company does not pay the tax. It's the individual owners, and they have to file it on their personal returns, and that's how the tax is paid. Private corporations do have to pay tax. The business has limited liability, kind of what we just talked about, and that naturally is a public corporation. The business is owned by its shareholders. That's a no-brainer, a public corporation. But these are good examples of the definitions that you need to take forward into this class coming out of chapter 1. Let's look at question 7, which is a good one. What do you mean when we say that corporate income is subject to double taxation? In other words, the income that Apple Computer uses or makes, which is a lot, billions of dollars every quarter, is double taxed. Here's what that means. In a corporation, once they have a profit, they have to pay a tax on that profit to the government, to the state they do business in, to the federal government, the corporate tax. Generally speaking, the corporate tax rate is roughly around 22%, depending on what state you live, but around 22%. But then once they pay that tax and have money left over, and they distribute that money in the form of dividends to their shareholders, once the shareholders get that dividend check, that money is also taxed on their individual tax returns by the federal government and the state that they live in. Two different parties are paying tax, but the corporation as a whole is double taxed. They pay a tax on their profit, and then the individual ownership of the corporation pays a tax as ordinary income on their dividends. Crazy. That's why a lot of corporations have a lot of tax breaks to avoid that double taxation. Their shareholders can pay the tax on dividends, but they get tax breaks from states and the federal government to reduce their corporate taxes. General Electric in 2021 made a profit of $1.2 billion, which isn't much for General Electric, but that's what they made. $1.2 billion in profit in 2021. They paid zero corporate tax. They had tax deductions. Okay, and finally, to summarize our chapter 1 reading, let's look at question 10. Which of the following are correct descriptions of a large corporation? Correct descriptions of large corporation. Now, first of all, I say, what do you mean by large corporation? What's a large corporation? A large corporation has more than 10 million shareholders, stockholders. That's a large corporation. So which of the following are correct descriptions of that? A, managers no longer have the incentive to act in their own interest. I don't think so. B, the corporation survives even if managers are fired, dismissed. That's correct. That is a correct description of a large corporation. Corporation survives even though management leaves. C, shareholders can sell their holdings without disrupting the business. And that's correct as well. If I sell my stock in Apple Computer Monday morning, I don't think Apple Computer is going to be in a state of disruption. Far from it. Stockholders can sell their holdings without disrupting the business. Because when they sell their holdings, they're just selling those stocks to another person who's going to own the stock. The stock is just not disappearing. Somebody else will own it. And D, corporations, unlike sole proprietorships, do not pay tax. Instead, shareholders are taxed on any dividends they receive. Well, that's partially right. Shareholders are taxed, but corporations do pay a corporate income tax. So the answers to this question 10 that are correct descriptions of a large corporation are B and C. So that pretty well summarizes the key points of chapter 1. Now let's take a look at chapter 2. Okay, here is chapter 2, which is talking about financial markets and the definition of financial markets. Chapter 1 talks about the definition of corporations and how corporations are different from sole proprietorships and partnerships. Here's a couple of questions. I'm on page 52 and 53 at the end of the chapter. And again, these problems you do not have to turn in. It's just a review by me in our Friday update video of key points that you will be asked and be part of future work in this class. So let's look at the first question. Corporate financing. How can a small private firm finance its capital investments? Give 2 or 3 examples of financing resources. Well, I think a good way of explaining what a small private firm to finance its capital investment is how in the late 1970s and early 1980s, Apple Computer started. Apple Computer now today is one of the largest corporations in the world. Matter of fact, I think as of today, it's the largest corporation in the world as far as market value. But it started out as a very small business with private investment. So how do they get financing? Well, first of all, they can get financing from family, from relatives, from private capital, giving them money as investments, private resources. Secondly, would be able to get another example of financing resources for small businesses, small private businesses, is getting credit from your vendors, credit from your suppliers. In other words, yes, you owe me $10,000 for some supplies, but you know what? Pay me 8,000 and I'll be happy. So they're giving a credit to them to buy certain supplies. It's called trade credit. And another source, as I just mentioned, as part of answer to the first example, was venture capital. You go outside from different than family members or people you know, you go to venture capital firms. Many times they're called hedge funds to give you private investment. So yes, capital investment can be made by outside capital, family, and trade credit. Let's look at question 2. The stock and bond markets are not the only financial markets. This is talked about in that PowerPoint I did in the first lecture video on Monday. Give 2 or 3 additional examples of a financial market. Well, one of them would be the money market. A money market where you can invest in money obligations like savings accounts, like United States Treasuries. In return, you get a money account. It's kind of like a mutual fund for cash. Secondly, you can invest in cash in exchange markets. You can buy the currency of other countries. You can buy currency, United States currency, the cash or foreign exchange markets. Another investment is the commodity market. You can buy wheat, grain, pork bellies. You can buy nickel, silver. Those are commodities, which is another financial market. And so those are examples. Money markets, foreign exchange markets, commodities markets, stock markets, bond markets, all places where people are either buying or selling capital. Let's look at question 5. This is something that some of us might be able to relate to, maybe not the dollar amount. You are a beginning investor with only $5,000 in savings. How can you achieve a widely diversified portfolio at a reasonable cost? You only have $5,000, but you don't want to put all that $5,000 into one company. That's a little risky. Where can you spread that out or diversify that $5,000? Well, the financial markets allow you to buy a mutual fund. Also today, you can buy a exchange traded fund, ETF, which is like buying a mutual fund, but you're buying specific stock certificates, stock shares in a fund. But where you can diversify a small amount of money is to buy into a mutual fund where they take your money along with many other investors with $5,000 or whatever, and spread that out and where you own a share of the mutual fund. Big mutual funds that you see are Vanguard, Fidelity. They own hundreds of different types of mutual funds that you can invest in, all different types of investments. Number 7, corporate financing. Choose the most appropriate term to complete each sentence. Households hold a greater percentage of corporate equities, stock, or corporate bonds. Most of the stocks in America and around the world are owned by households, you and I, 401ks, IRAs, insurance funds, pension funds. Corporate equities hold a greater percentage of household investments, corporate equities. Pension funds or banks are major investors in corporate equities. It's got to be pension funds. Your pension fund of your employee, your 401k, your 503b if you work for a not-for-profit. Those pension funds invest in stock. Banks are required, are not allowed to invest in corporations due to their limits as Federal Reserve requirements of owning a bank. Banks cannot own stock in other companies. They can own stock in their own company, but they cannot own stock in other businesses. Investment banks, commercial banks, raise money from depositors and make loans to individuals and businesses. That is called commercial banking. Investment banking is they take the money from depositors and actually invest and create capital for companies. But commercial banks supply loans to individuals and businesses, not stock investment loans. Commercial banks. Two important parts of corporate financing: investment banks and commercial banks. And finally, here's 4 examples of financial markets. Which of these are actually financial markets? NASDAQ? Yes. Vanguard Explorer Fund? No. That's a mutual fund that we just talked about. That's one of Vanguard's largest mutual funds. JP Morgan Chase? No. That's a investment bank. And Chicago Mercantile Exchange? Yes, that is a financial market. You can go to the Chicago Mercantile Exchange and buy commodities, buy all different types of investments. Interesting sidelight to the Chicago Mercantile Exchange. You know who created and invented and was the owner of the Chicago Mercantile Exchange? The Kennedy family. President Kennedy, Robert Kennedy, Ted Kennedy, and all the grandchildren subsequently. Joseph P. Kennedy, the father of the president, created and invented and opened up the Chicago Mercantile Exchange. And that was an exchange that he ran or was able to offer commodity trading out of Chicago. Now, the thing about that is the untold story in many ways. How did Joseph Kennedy get the capital to create Chicago Mercantile Exchange? Well, he was an investor in Hollywood, in movies in the 1920s, but also more importantly in the 1920s, he was a bootlegger. He made his money selling alcohol when it was illegal in America during Prohibition in the 1920s. That's how he got his money. And then he invested it once Prohibition ended, and he invested and created the Chicago Mercantile Exchange. And to this day, the Kennedy family still owns part of that exchange. Pretty good. So NASDAQ and Chicago Mercantile Exchange are financial markets. Vanguard Explorer Fund is a mutual fund. JP Morgan Chase is a bank, not a market. Okay. Well, those pretty well define financial markets and what you need to get out of chapter 2. Next week, we go into chapters 3 and 4 and talk a little bit about financial statements and financial analysis. Be looking at going back to your old days of when you took accounting of what you created in the balance sheet and the income statement and the statement of cash flow. That's our main topics in week 2. But for now, this concludes our update video for week number 1, the review of chapter 1 and chapter 2, and introducing you to, for many of you, the portfolio and creating a portfolio of the financial markets. Thanks, everybody. We'll see you again on Monday with our week 2 lecture video. Please, over the weekend, get caught up. If you're just signing on this weekend to the course, make sure you know what you're doing. And I'll look forward to seeing you all next Monday, April 11th. Until then, adios.